Making money from money involves strategies that leverage existing capital to generate more wealth. Here are some detailed concepts to understand. 1. Investing in stocks. Dividend stocks. Investing in companies that pay regular dividends can provide a steady income stream. Dividends are profits shared with shareholders and can be reinvested to buy more shares. Growth stocks. These are shares of companies expected to grow at an above-average rate compared to other companies. They usually don't pay dividends but reinvest earnings to fuel growth. Index funds or ETFs. These are funds that track a specific index, like the S&P 500. They offer diversification and are a passive way to invest in the stock market. 2. Bonds and fixed income securities. Government bonds. Loans made to the government in exchange for interest payments over a fixed term. They are considered low risk and provide steady income. Corporate bonds. Similar to government bonds, but issued by companies. They typically offer higher interest rates, but come with higher risk. 3. Real estate investment. Rental properties. Purchasing properties to rent out can generate a regular income stream. The property value might also appreciate over time. Real estate investment trusts REITs. Investing in a REIT allows you to invest in real estate without having to own physical property. REITs pay dividends from the rental income of the properties they own. 4. Mutual funds. Actively managed funds. These are managed by professional fund managers who actively pick stocks, bonds, or other assets to beat the market. Passively managed funds. These funds mimic a specific index or sector. They usually have lower fees because they don't require active management. 5. Peer-to-peer lending. Platforms like Lending Club or Prosper allow you to lend money directly to individuals or small businesses in exchange for interest payments. This can be riskier but potentially more profitable than traditional savings accounts. 6. Cryptocurrency. Investing in cryptocurrencies. Digital currencies like Bitcoin, Ethereum, and others can be highly volatile but have the potential for significant returns. It requires careful research and understanding of the market. Staking. Some cryptocurrencies offer staking, where you can earn rewards for holding and validating transactions on the blockchain network. 7. Commodities. Gold and silver. Investing in physical commodities like gold and silver can serve as a hedge against inflation and economic uncertainty. Oil and natural gas. Investing in energy commodities can be profitable, especially in times of economic growth, but also carries significant risk due to price volatility. 8. Building a business. Starting a business. Investing money into starting a business can lead to substantial returns if the business becomes profitable. Franchising. Buying into a franchise allows you to use an established brand and business model, which can reduce the risk associated with starting a new business from scratch. 9. Leveraging interest rates. High-interest savings accounts. These accounts offer higher interest rates than regular savings accounts, providing a safe way to grow your money. Certificates of deposit CDs. These are time deposits that pay a fixed interest rate for a specified term, offering higher returns than traditional savings accounts with minimal risk. 10. Options trading. Call and put options. Options give you the right, but not the obligation, to buy or sell an asset at a predetermined price before a specific date. This can be a way to make money if you correctly predict the movement of an asset's price, but it's highly risky. 11. Foreign exchange. Forex trading. Currency trading. Forex trading involves buying and selling currencies in the foreign exchange market with the aim of making a profit. It requires understanding global economics and market trends. 12. Passive income streams. Royalties. Earning money from intellectual property like books, music, or patents. Affiliate marketing. Promoting products or services online and earning a commission for each sale made through your referral. 13. Dividend reinvestment plans. DRIPs. Reinvesting dividends. Many companies offer DRIPs, which allow you to reinvest your cash dividends to purchase more shares of the company, compounding your investment over time. 14. Venture capital and angel investing. Investing in startups, providing capital to early-stage companies in exchange for equity. This can yield high returns if the company succeeds, but it's also very risky. 15. Tax-advantaged accounts. IRA 401k. Investing in tax-advantaged retirement accounts allows your money to grow tax-free or tax-deferred, maximizing long-term growth. Key considerations. Risk tolerance. Understanding how much risk you are willing to take is crucial in choosing the right investment strategy. Diversification. Spreading your investments across different asset classes reduces risk. Time horizon. Your investment time frame will influence your strategy. Long-term investments often yield better returns with less volatility. Research and education. Staying informed about markets, investment vehicles, and economic trends is vital to making informed decisions.